The Nasdaq's made a bit of a bounce, David, and earlier in the conversation on this program, we were talking about whether there is a correlation or a causation between what happens with rates and what happens with growth, big tech. What are you and the team saying about that?
So the interplay between growth and rates and inflation obviously has a lot of different dynamics, and I would unpack that in sort of two ways. How does inflation affect the equity market, broadly speaking, and then which sectors in particular? And so we think about it, the transmission mechanism on the one hand is on valuation, because the impact of higher inflation leads to generally higher rates, and that has an impact particularly on some of the longer duration, longer expected growth stocks. But there's also a transmission mechanism through margins. And so I think we need to bring both of those together and think about it. What is one of the attributes of the technology sector is they have extraordinarily high margins, and they've been relatively immune, pun intended there, relatively immune from the higher inflation curtailing their margins. So on the one hand, you have a suppressing or a depressing effect on valuation for inflation and what that means for rates and the valuation of that long-term expected growth. And on the other hand, you have the durability of their margins as compared with some other more cyclical sectors where their margins may not be so robust in terms of ability to pass through those higher input costs. So I think those are the two things that we are trading off one against the other. And I think my view is that the margins are going to become the more dominant topic of conversation. The idea of transitory is a debate we will be having consistently until October, right? We'll put a stake in the ground and say that's for 6 months. And so the Fed has indicated its view. My colleagues at Goldman Sachs economics team also have a view that the inflationary impulses are relatively transitory, and then we'll recede back towards the sort of 2% core PCE next year. So that's sort of the issue. We're going to have that repeatedly. I think the more interesting analytical debate with portfolio managers is around the durability of margins. And margins, Jonathan and Tom and Lisa, have recovered now to their pre-pandemic levels. So they're already back to where they were February of 2020. And so the question is, from here, where are we going? And my view is margins are going to be relatively flat. And a big variable there is the tax rate, the corporate taxes. If you told me for a moment we will not have corporate tax reform, then we'd have earnings growth of around 10% from this year into 2022. Now, that's not our view. We expect there's going to be an increase in corporate taxes, and that is going to mean that growth in earnings is going to be around 5%. And so you pay a different multiple for a 5% growth as opposed to 10% growth.